I will give everybody a second to come from the waiting room. And hello and good afternoon, everybody. Thanks so much for joining us at the New Jersey Business and Industry Association's Business Growth Roundtable. We at NJBIA are thrilled to have helped create this incredible initiative led by such amazing women. For those of you who are new to NJBIA, we are the nation's largest statewide business association, representing about 1/4 of all New Jersey employees. We offer customer development opportunities, visibility through events, magazine ads, or our podcast and TV show, and money-saving discounts on stuff your business is probably already paying for, like payroll, healthcare, training, a 401k solution, and 24/7 HR support. I'm Betty Boris. I'm one of the executive leaders here at NJBIA. And if you're interested in more information on us, I'll drop the website into the chat along with my contact information. Please feel free to be in touch and we can get you whatever you need. And with that, I will turn it over to the marvelous Vicki Hart of Paradigm Marketing and Design. Enjoy the program.
Well, thank you so much, Betty. Hello, everyone. I am Vicki Hart, Director of Client Engagement at Paradigm Marketing and Design. We are an award-winning strategic agency that specializes in working with business and nonprofits with a complex sale and makes sales teams more effective and more efficient. How do we do it? Through sales and marketing tools, strategy to drive conversions, and workflow to create efficiencies. So when you're thinking of Paradigm, I always love to talk about superhero powers. Ours are generating quality leads, shortening sales cycles, and making sales teams more effective. So I'm delighted to be here and introduce our fabulous sponsors. You know, putting on these events takes friends, and we are so grateful for our friends and our sponsors. And I would first like to introduce Laura Carruthers Osborne from Carruthers Consulting. Laura Carruthers started Carruthers Consulting to help leaders gain clarity around people, leadership, and culture. 12 years later, the Carruthers team of more than 25 provide a creative and unique way of training rising managers and leaders across the U.S., increasing their leadership effectiveness. Leaders and HR teams rely on Carruthers fractional HR leadership to understand the nuances of high-growth organizations as they design HR programs and fine-tune their practices. So we are grateful for our partnership with Laura. And next up, and we're going to be hearing from our friend Kim shortly, who will be moderating our panel discussion today, is our friend Kim Luthi from, she's Director of Wealth Planning at Synthesis Wealth Planning in Morristown. Kim is a strong advocate for her clients, helping them understand where they are and where they are going, and helping determine what the right path to their financial independence looks like. The world, as she says, is always changing, and I'm sure we can all attest to that. Our family, our career, tax laws, product and planning opportunities are always evolving. And as your personal financial CFO, I mean, who couldn't use a personal financial CFO? That's pretty amazing. She helps her clients find clarity in the confusing world. Kim takes her clients through a process and helps them to know what the next best step is, providing clients with a peace of mind. She celebrates her 35th year as an advisor, which I know is absolutely impossible because you have to be more than 7 to be an advisor. So Kim, there must be a typo there. But with her 35 years of experience, she's always saying how grateful she is for all the lives she gets to touch, making a difference when her clients are worried about retirement, taxes, caring for their parents, and their children, running their businesses. It's a driving force for Kim. So please visit Kim at Synthesis Wealth's website to get to know Kim. And thank you again, Kim, for your support. We look forward to hearing from you just momentarily. And last but not least is Cal Thomas from Sandler Training. What can I say about Sandler Training? I actually can't say enough. Me and my team are actually Sandler trained, and it took our close rate, and I kid you not, from 40% to 70%. That is not an error. From 40 to 70% through understanding and practicing the Sandler submarine, for those of you who know. Last year, actually, I kicked off the new year with a refresher. And I got to tell you, it was a great way to kick off the new year. And it's amazing. It's an investment that you make in your business and in your own success. So thank you, Cal, for your support. And before we move on, I'd like to let you know that our next business roundtable is going to be in January. I don't even believe the words January and 2024 are leaving my lips, but they are. We're going to have Rachel Durkin, who is the founder of Paradigm Marketing and Design, discuss marketing in a volatile economy. So I'm going to drop the link into the chat. We hope to, oh, look at that. Kelly, you are amazing. Kelly's in the background making magic happen. So we hope to see you there. If for any reason we will be recording. So if for any reason you cannot make it, make sure you register. You'll get the link. This is valuable information to take you into 2024. So without further ado, I'm going to pass the baton to the legendary Kim Luthi of Synthesis Wealth. Kim, welcome to the stage with your panelists.
Thank you. And let me do a little introductions, or shall I introduce Kyle and Anu? I think so. All right, let me do that a little bit. So happy to have with us today two very esteemed speakers, leaders in the communities and the financial services industry as well. Anu is a vice president of capital markets strategies for Fidelity Institutional. And Anu is going to talk to us today a little bit about her insights from the capital markets perspective. And Kyle is Director of Economic Policy Research from NJBIA. So between the three of us, we're happy to share this 2024 analysis for what's coming. In fact, in the introduction, Vicki mentioned that one of the things that I like to hang my hat on is that change is constant and we need to be prepared for it. So let's talk about what's happened, maybe do a little recap in 2023 and real quick, and then kind of give our insights here about what's happening coming 2024. So Anu and Kyle, if you would unmute yourselves, we can start our discussion. And thank you again for joining us. Really happy to have you both here. So let's start with 2023. Here we are wrapping it up, end of December. Like we said, can't believe 2024 is coming. In fact, Rachel talking next year about 2024 and marketing. We're going to talk about 2024 business in New Jersey and the markets and so forth. So Anu, tell us about your kind of just quick overview of what you thought you saw in 2023 happening and where we are now. Looking ahead, going into 2024.
Certainly, Kim, and thank you for having me here today. So as you said, we are in the home stretch of 2023. And if I have to reflect back on how this year panned out, in one word, for a person like me in my role, I would say it was frustrating. And the reason for that, it wasn't like the market's returns were not great, because if we had to freeze time today and close the calendar year like it is the end of the year today, S&P 500 is up over 20%. And for a lot of us doing what we're doing, well, we know 20% return for the S&P 500 in any one year, that is an extremely strong year in the markets. So why would I say it's frustrating? Well, because for analysts, for economists, for forecasters like myself, this year has been very hard to pin down. So we came into the year expecting a recession in 2023, an economic hurricane, major economic slowdown. The Fed was raising rates. So the market expected we would end up in a recession. The market expected that corporate earnings would decline. Well, sitting in last few weeks of December, last few weeks of the year, where are we? Well, that recession did not happen. The economic hurricane did not make a landfall this year. We did not see declines in the markets for the most part. In fact, in the first half of the year, it was one of the strongest first halves of the year. And earnings kept rising. We did lose 4 regional banks, but in the midst of all of that, the S&P 500, 20% up, which probably, which qualifies as a bull market right now.
Yeah, and you mentioned we didn't have a recession. In fact, I think there was a lot of conversations about if we did, what type it would be, a soft landing and so forth. Maybe you can describe a little bit of that.
Most certainly. So again, coming into the year, the market expected something called a hard landing. So what is a hard landing? Well, a hard landing would be when GDP or the economy actually contracts. We did not get that. In fact, in the third quarter of the year, the economy actually grew 5.2%. So that's actually a very, very strong economic growth for one quarter. Now, a soft landing is if the economy actually does not see a decline or a contraction. And that's what the market's expecting right now, because the market's now moved to saying that, well, we're not getting the hard landing. The Fed managed to thread this needle just right, which, just given historical track record of the Fed, doesn't usually happen. The Fed doesn't have a great track record of pulling off soft landing. But now the market's expecting that, well, the Fed actually did what it probably doesn't have a great track record of doing. It is going to get that soft landing, which means the plane probably has a very nice landing and actually starts to take off again, or economic growth continues to grow. Maybe not at 5.2%, maybe at 2.5%, but most certainly not a negative number.
Mm-hmm. And Kyle, did you find that, tell me about New Jersey in a news insight there. Was that similar to what you saw here in Jersey?
Sure. Thanks, Kim, and good morning to everybody. I want to take a step back. I know Anu started with kind of the capital markets, so I'm going to step back to the more macroeconomic perspective. And I always caution before I do, I'm not an economist, but I do spend a lot of time looking at these things and trying to understand them. So I think in New Jersey, really, it was conflicting signals throughout 2023 in a number of ways, and especially the ones that are most felt probably by the folks on this call, and especially just households and families. So for instance, when we talk about soft and hard landings, we're talking about the Fed's attempt to curb inflation. And largely, I think that effort has been successful. So at least on a year-to-year basis, you're watching inflation come down. The rate at which prices are rising on an annual or monthly basis is slower than it was a few years ago. That would be good news. On the flip side of that, we've watched unemployment in New Jersey rise faster than it has in any other state over a 12-month period. We went from somewhere in kind of the middle of the pack about a year ago to now being one of the highest unemployment rates in the country as we stand today. No other state has grown that quickly in terms of its unemployment rate over the past 12 months. So obviously that is not going to feel good for workers and folks on the ground. But it also signals that trend we were feeling moving through 2022 reverses course. On the other hand, I know Anu was speaking to GDP on the national level. Unfortunately, one of the things we have to deal with when we talk about data and numbers that come out from these federal agencies is they often lag considerably behind the moment that we're actually in. We only just got second quarter figures for this year for states about a week ago. So we only just found out what the situation was in the state. The good news was that New Jersey had a relatively strong second quarter. I think it grew around the national average or exceeded it by a few percentage points. But they revised backwards our number from the first quarter to show that actually GDP in New Jersey contracted in the first quarter of 2023 and was one of just a number of states to do so and was far behind the national rate. So all throughout the economy, we have these conflicting signals throughout 2023 and kind of these reversals of trends from the prior year. And I think a lot of that is felt at the household and the business level, where you're watching inflation come down and that feels like it should be a good thing. But you're watching unemployment go up, and that likely hurts you a little more. GDP probably isn't something you are feeling. That more describes something you probably felt a couple of months ago. But likely those Q1 contractions were something you already felt in January, February, and March. So from my perspective, 2023 has kind of been a rolling back of trends that we experienced in 2022 and bringing back in this period of uncertainty as we talk about hard and soft landings and how that may affect us at the state level.
Yeah, and you mentioned that we have New Jersey as the highest unemployment rate, but yet you also, I know in previous conversations that we had prepping for this call, that we also have the overall that we're ticking up, and each month we have the overall number of workers in the labor pool is growing. So if we have high unemployment rate and increasing labor, people available to work, how do you describe that? And by the way, I think both Anu and you can comment on this. You're doing, like, we have to look back to look ahead. And we also were fighting the media, right, for mindset for everybody. So what were your thoughts on New Jersey? Why we have so many workers, but yet we have the highest unemployment rate?
Yeah, and this has reversed course slightly in the last month or two. We've started to see that total labor force come down a little bit, but even in the months where we were gaining in unemployment, we were also watching our total labor force increase as well. And so for folks on the call who don't spend all day, worrying about these numbers, the total labor force is not only everyone working, but everybody who then says they're looking for work. So on the one hand, you can have a dynamic where your labor force is increasing because more people are entering that labor pool and want a job, but don't necessarily find it right away. So it's not counterintuitive entirely that those numbers could increase at the same time. They also come from different survey instruments that are put into the field by the Bureau of Labor Statistics. So you can also get different samples and different metrics that way. I think more specifically, though, when you talk about why might labor force be high and unemployment be high as well, the Wall Street Journal just did a pretty strong write-up on this within the last week or two. When we look at the industries that are hiring in New Jersey and the industries that most say they cannot fill the open jobs, they do not or may not necessarily align with the individuals who are getting laid off if they are, or who are looking for work. So an easy example of that is nurses. There's a nursing shortage throughout the country, and we have that in New Jersey as well. If I lost my job tomorrow, and I should knock on wood because I don't want to speak that into existence, it's not like I can go to RWJ Barnabas and fill a nursing job. I can't go to Cooper Hospital in Camden, where I live in South Jersey, and take that job, even though they are desperate to get somebody in, right? So you also have this potential for mismatch between the workers who are available and the workers who are needed in their industries. And we can talk about shifting worker expectations and things as well, but I want to leave an opportunity to address the question as well.
Yeah, most certainly, Kyle, you make a great point about just a mismatch between who's available for work and what kind of roles are available. So you mentioned about New Jersey and how unemployment rate has risen, is the highest in the country. Now, at the country level, at the aggregate level, unemployment actually declined in the last reading. It went down to 3.7%. So what's going on? Well, what we've seen is layoffs happening in very, very specific sectors. So coming into the year, we started to see layoffs happening in technology, in mega cap tech companies. Thousands of people were getting laid off at Amazon, Microsoft, Google, you name it. However, we did not see unemployment at an aggregate level rise significantly. So why was that the case? Well, as much as the media focuses on these mega cap tech companies, because of course it is more exciting to, or more interesting, it gets more clicks if there's an article about Microsoft, an article about Amazon. I mean, who wants to read about a railroad company in Milwaukee? So the media focused a lot on that, and most certainly for people losing their jobs in those specific sectors or industries, it does hurt. However, at an aggregate level, the entire information services industry or sector accounts for less than 3% of the country's employment or labor force. So why is the aggregate unemployment not rising? Well, because the bulk of America, or the greatest percentage of America, works in healthcare and education. And Kyle, you pointed to the labor shortage in nursing. Right? So till the time we start to see Main Street America start to lose their jobs, like, you start to see education workers start to lose their jobs, or healthcare workers start to lose their jobs. At an aggregate level, we may not see these unemployment numbers spike up as much.
Yeah, and we also talked about, I know it was a phrase used last year, the Great Resignation, right? And these unemployment numbers are also, there's people not coming back into the job market. I mean, I have many conversations with clients who are literally packing up and moving to different parts of the country, getting closer to family, just deciding to change their lifestyle. When we go through the cash flow scenarios, what can they afford to do? What are your thoughts on, the labor pool itself going forward?
Oh, yeah. So the labor pool, as Kyle mentioned, even at an aggregate level, is higher than where we were pre-COVID. But the number of people employed is also higher than pre-COVID. And during COVID, we did see this shifting of labor force from parts of the country that, for whatever reasons, either taxes were higher, real estate was higher, travel times were higher, families were far from, their extended families, etc. So a lot of relocations happened. So that accounted for some of that great resignation. But also up until last year, the labor market was just so piping hard that when people left their jobs and found something else to do, they got major boosts in their salaries and their wages, etc. So that also accounted for that great resignation. There was just too much demand for labor. Now that narrative has most certainly changed this year. So we're not seeing as much of that great resignation because one is the labor market is tight, but it is less tight than it was last year. So to Kyle's point on reversal of some of those trends that we were seeing last year, we are certainly seeing that. However, the market still remains tight because even as of today, there are about 1.3 job openings for every available US worker.
Yeah, and Kyle, I'm sorry, go ahead. You wanted to add something?
No, I'm sorry. I was going to make 2 points, I think. So number one, we can see everything Anu said is exactly right, and we can see it in the numbers as well. So Bureau of Labor Statistics puts out a stately report called JOLTS. It's Job Openings and Labor Turnover Survey. We see in that if you go through 2022, that great resignation continued and actually only accelerated. And we've written about this over at my other time that I spend with a nonprofit called Focus New Jersey. In 2023, however, we really start to see that number of people who are leaving a position under their own volition, for lack of a much simpler term that's escaping me, right? Those individuals have declined significantly in 2023, even though the hiring rate has stayed relatively stable. And so what that tells us is that there's just not as much certainty and comfort among workers to leave a job. Maybe you don't have one lined up yet and you're thinking, well, this is a strong economy, I will find the next thing. To Anu's point, maybe you're moving, you're going to work remotely, there's going to be new opportunities. So we can see in the data that that's not happening as much. The other point I make about feeling those labor shortages is, one, some of the places with the most labor shortages are some of the most visible to everyday consumers. So retail and hospitality, healthcare, places that you are going to experience face to face. If there are not enough people to staff your local retail store and you can't get the help that you need, or you can't get somebody to make the food that you want, you're going to feel that much more than if an accounting firm is short a couple of accountants, and they may be, but you, the individual consumer, just may not see that as readily if you're not in that industry. The other point I would make is when we look over a 5-year span, which I can't believe it, but that's what we're getting close to doing when it comes to talking about COVID and the impact that that's had on our economy. We still talk about a lot of these levels in terms of getting back to pre-COVID figures and getting back to pre-COVID levels. But over 5 years, we would also anticipate growth in all of these industries. So if we're only getting back to pre-COVID levels, we are losing that 5 years of growth that we would have anticipated. So if the business or the industry was continuing to grow, but the number of employees is only just reaching back to pre-COVID levels, you are still going to have a shortage, even though it seems like those numbers should line up. And so that may also lead to you feeling some of those worker shortages more than you otherwise would.
Yeah, and I was going to say before you brought that in was Main Street, right? Here we are looking at Main Street. I, like everyone else, can drive down and see a lot of empty storefronts. And to your point, I think a lot of them are those retail or food service. I have clients who are in sales for the food service companies, and they tell me sales are down. I said, well, why would that be? I think it's because there's less of them to go to and they can't get the workforce. I said, and I even said, well, aren't there more people maybe doing takeout? If they were doing takeout, then their numbers would be up. So, looking down on Main Street when you have all these buildings empty, what does that say to people and how does that affect their mindset for the economy, particularly in New Jersey?
I think this is where, and this is a national conversation I think is playing out every day, is the perception of the economy and its strength versus what the numbers tell us. And for folks like myself, and I'm sure Anu and maybe some others on the call who spend their time looking at the numbers, it's sometimes harder to understand where the perception doesn't match them. I think an easy example is we can talk about the inflation rate, and we can talk about the inflation rate coming down to 4% or 3.5%. That is a good economic story for the country and for New Jersey on that annual basis. What that doesn't help the consumer, or where that doesn't help the consumer, is that it ignores the reality the prices are still 15 or 17% higher over a 3 or 4 year period. Most consumers don't limit their understanding of what prices are to the last 12 months, right? We all remember what prices were 5 years ago, 10 years ago, 15 years ago, right? And so that sticker shock is real. Now, on Main Street and the actual economic consequences, we're still dealing with fallout from a number of things over the pandemic. So obviously a headline is remote work. On your local Main Street, I'm not sure the remote work has as much of an impact. Certainly in urban downtowns, we're still feeling the impact of that and figuring out how the long-term ramifications are going to shake out of remote work. If there aren't as many people coming into the office on a day-to-day basis, then there's just not as many people that are going to be there to go to the restaurant next door, go to the coffee shop, or use the dry cleaner. So those ramifications are still real. The secondary piece to that is then also if everybody is, if remote work isn't just taking people out of the office, but people are actually moving away and they're saying, well, then I don't need to be in this place or in this town. Are they not there to get the takeout? If the economic conditions are worsening and people are starting to feel that, are they tightening their belt? And so, the takeout number goes down as well. The last thing I would note is, and we may get to this later in the discussion, but as we get into 2024, we're also seeing what I would call kind of cliffs from pandemic era programs. And so one may be Main Street recovery programs or programs like the child tax credit, other things that was putting money either in the pockets of business or pockets of individuals to kind of help keep some of these places afloat and help keep that demand there. As we reach the end of those programs, you're also going to see sudden impacts of them that maybe you would have thought would be there 1 or 2 years ago. You might be thinking to yourself, well, the pandemic, all these business closures ended 2 years ago. Why are we just feeling the impact of some of these? Well, because there's been federal and state programs to help keep certain industries afloat, and they may be coming to the end of their life cycle as we head into 24 and beyond.
Absolutely. And I know that you can join in on this topic about, you mentioned before that the Fed threaded the needle properly for the first time in a long time. And, as they slow that financing back to all of the economy and people and putting money into our pockets, as rates are up a little bit right now, let's say in short-term instruments, CDs and so forth, I tend to get a lot of calls about why would I want to be investing in the stock market? Because you did mention earlier that it did around 20%, but let's be honest, it was based on the Magnificent Seven, right? And so a lot of these big companies, Google and Amazon and so forth, drove those markets. So when I have clients that talk about, well, how come my portfolio only did 8 or 9 or 10, which is fantastic, right? But the S&P did 20. Talk to us about, what that means as far as going forward for interest rates, because short-term money is cheap, or not cheap. I'm sorry, they're paying high rates, but it's also kind of luring people in to not put into the market and put it in, and then what they're going to miss that uptick.
That's right. So the way I describe short-term money, or that money sitting in money markets and CDs, and trust me, we have a ton of it is sitting in money markets and CDs right now. And as you said, when those instruments are delivering more than 5%, which, by the way, they haven't done in a really, really long time, why take on that additional risk of investing in equities, which if you don't catch the right ones, the Magnificent Seven, you're probably not going to see those 20% returns. So the lure of those money market CD rates, etc., is extremely high, and I get it. However, I describe them as a warm, fuzzy blanket. It feels good to be in that warm, fuzzy blanket, especially if, as Kyle's been talking about, and I've also alluded to that, well, things might be slowing down. The labor market is slowing down. Inflation's coming down. But we're still processing all these higher rates, etc. So if things are slowing down, we are going into the winter season. Why get out of that warm, fuzzy blanket? So my response to that is it is good till it lasts. And it has a definite expiration date. And that expiration date is the Fed's cycle. And for now, we know, and we'll hear from the Fed later today in an hour and a half, but we think the Fed is done. What does that mean? Well, we think that the Fed is done with hiking rates. And once the Fed is done with hiking rates, maybe the Fed stays here for a little bit, but the next big move from the Fed is to start to cut rates. And when that happens, well, those money market rates, they reset overnight. So when the Fed starts to cut rates, those rates start to come down as well. So which means that now is the time you want to start to rethink that asset allocation for the longer term, because we are all in this for the long term. We are not in this for the next 3 months or 6 months. We are in this for the long term. And keeping money in money markets and CDs under your mattresses, that doesn't help us achieve our longer term financial goals.
Yeah, that's true. Kyle, anything you want to add to what you see happening in Jersey?
No, I think, I mean, looking ahead to 2024, just more broadly, I think the situation in New Jersey remains uncertain, if I haven't used that word already. I mentioned the GDP figure, and so we don't know what Q3 from this year is going to look like, and that'll give us a sense of where we're headed in 2024. The unemployment situation also is kind of on an edge right now. I think when we talk about unemployment, we're still in a situation where we're saying, unemployment is rising, but it's still relatively low historically. We can only afford so many more increases before we're not really saying, 6% isn't low. We're not at 6% yet. We're still somewhere around in the fours. But as if you continue to climb at the rate that we are, we would be at 6% in 2024. I don't think we would still be saying that that's an incredibly low unemployment rate, like when we were increasing month to month, but we were at 3.2%. There's not a whole lot of people who are going to cry over 3.2%. So we're still kind of watching how things shake out to figure out exactly where we're going to end up.
Yep. And Neil, when you touched upon the liquidity and what the Fed is doing, I think that's also part of the reason why some of the clients that I talk to are trying to keep more money liquid. And I think that's probably a good strategy, because we don't want to spend beyond our means, right? We want to have a certain amount in short-term instruments, but asset allocation is important. Thinking about where they should be investing, I know you had some thoughts related to bonds. Tell us a little bit about your thoughts in the bond market.
Well, certainly. So bonds or fixed income hasn't really worked for a lot of investors over the last almost 2 decades, if not more. And the reason for that really has been very low interest rates. Because if you think about how fixed income instruments generate returns, the biggest component to that is income or coupons. And there were really no coupons to clip in those fixed income instruments, which means for fixed income investors, they had to get really, really creative and take on more risk in fixed income to generate those returns. The good news with all these rate hikes, if there is to be one, is that now fixed income instruments actually have a coupon that is quite healthy, that investors can clip and generate income without taking on too much risk. So money markets, CDs, etc., are also fixed income type of fixed income instruments. However, they are extremely, extremely short-dated instruments. So as I said, there is an expiration date to that. So what do we do with that fixed income allocation? Well, we move up the duration a little bit. In other words, we invest in slightly longer dated bonds. And by doing that, we lock in those higher rates, which generate those better coupons. And we lock those rates in before those rates start to drop.
Right. And so maybe a strategy of creating like a bond ladder, right? Where you're Is that something meaning, and maybe you can describe it. I mean, I know what it is, but that might provide future streams of income in retirement. And there are multiple ways to generate income in retirement. We have pensions, if you're lucky enough to have them, very few companies. We'll have Social Security, we'll have investment income. You can have guaranteed streams of income from annuity-based products, or you can, or in combination, doing some type of bond ladders.
For sure, bond ladders is one of the approaches where you buy individual bonds that expire at different times in the future. And by doing that, you are generating streams of cash flows that are somewhat aligned with your liabilities or aligned with when you need that money. So unless that bond defaults, you are almost guaranteed to get back that principal and that coupon in that time frame. So that's one approach. The other approach would just be simply buying a bond mutual fund or a bond ETF. Now, for bonds, I would go with the mutual fund. So what happens with mutual funds is it's an active manager, and that's what that manager is doing day in and day out, buying different bonds of different maturities, all within one wrapper of a mutual fund. So you're not buying individual bonds, but you're buying almost a basket of bonds wrapped all into one nice package.
Okay. So looking ahead now for 2024, Kyle, what are some of your thoughts about New Jersey and where you see the economy going, and how we can help as consumers, or what should we be doing differently?
Yeah, and I know I already alluded to the uncertainty. In terms of consumers and behaving differently, I'm not sure that there's too much to say. I mean, I think it's going to depend on the individual basis. The one note of optimism, and I don't want to steal, I think we may have wanted to end optimistically, but I'll give my optimistic note now, which is that we have been talking about a predicted recession for seemingly 4 years now. And despite the fact that these predictions come from people much smarter than myself, people much more knowledgeable than myself, we keep not seeing that recession. And so the first thing that I would say at the consumer level is that worry about what you can control, worry about your own finances, your own business. You're going to have a better idea of the conditions that are affecting your pocketbook or your ledger than anybody on this panel is, and anybody who's talking about this macroeconomic view. You're going to know if you're facing hard times or not. On the individual consumer level, it's the same idea. Obviously, everybody is struggling in terms of dealing with inflation, whether that's a perceived struggle, it's a mental struggle, or it's a literal struggle of not being able to put food on the table. We can talk about wages increasing at higher rates than they did in decades past that match that inflation rate. Again, all that we want, but you're going to know whether or not your budget is getting tighter. So the number one thing I would say on the consumer level is, as much as these macro trends matter, and you should be paying attention to them so that you're informed and you're aware of what's happening in your state and in your country, at the individual level, you should be much more concerned about your own budget, your own business, and what the trends that you're seeing are, and making sure that you're keeping up with them. If you're constantly preparing for a recession that never comes, you're going to miss a lot of opportunities. So yeah, I would be much more concerned with the situation on the ground that you're facing.
Yeah, and I agree with that. I tell people, if you ask 10 people the same question, you're going to get 10 different answers, whether it's finance, politics, religion, I don't care what it is. So, it's very important when we meet with clients to talk about what keeps you up at night. Everyone has a different sense about money, how they come to the table, what they grew up with. Did they have a lot of it? If so, do they spend too much? Did they not have enough? Do they hoard it? Right. So I think it's important that everybody does their own analysis and figure out where they're going. But I talk to clients of all different levels, and everybody has seen the increase in the costs at the food store and the energy costs and things like that. And so it is challenging. So we understand that that's happening. And since we are good news, bad news, living longer, right, we have to plan for that longevity, because things like Social Security was never meant to be the primary source of income for people. So being more in tune to what's going on and getting help, getting information, but be careful where you get all your information, because it can be debilitating. Too much, right, can paralyze you. Anu, what do you think about going forward in 2024? What do you see some opportunities for clients and for people out there concerned about what's happening now? Because we also talked, by the way, when we had our pre-conversation about the media and how that affects us. So talk about where you see 2024 going, and like Kyle mentioned, on a positive note.
Absolutely. So going into 2024 at a very high level, macro level, inflation has started to come down materially. We peaked last year at inflation of 9.1%. We just got the number this morning, and that's at 3.1%. So a third of the peak. Now, that certainly means we're seeing disinflation. We are not seeing deflation. And the difference between the two, it means is that prices are rising slower, but that doesn't mean that prices are actually declining from where they were a year ago or a year and a half ago. So the good news here is that the incremental price increase is reducing, which means for the Fed, they could maybe start to take their foot off the brake a little bit. And now, how does that help Main Street? Well, it helps Main Street because for consumers, what do we feel? Well, we feel higher mortgage rates. We feel higher credit card rates, interest rates on credit card balances. Main Street America is mostly smaller and medium cap companies. These companies feel higher bank loan rates. So now all of those trends could start to reverse in 2024. We could potentially start to see mortgage rates, who knows, maybe they don't decline, but they probably won't increase as much. So we may not see another 8% on the mortgage rate. That makes it a little bit easier for some people who are looking to buy homes. Credit card rates, right now they are over 20%. Hopefully those come down as the Fed starts to cut rates. Banks, small cap companies, right now when they go to borrow from banks, those bank borrowing rates are over 10%. Hopefully they start to come down when the Fed starts to cut rates. So the good news is that there is a lot to look forward to in 2024. So constructive there. Do caution that we still see a lot of uncertainty because we are still processing all the rate hikes that the Fed already gave us. And rate hikes or monetary policy acts with a lag. So we are still cautious that we could potentially keep seeing smaller things break in the meantime as we reverse course and as we start to rise again.
Mm-hmm. Now I know I'll bring everybody back on the line because I know that we've had over 30 or more questions that came in while you guys were speaking, and we had a series of questions that came in preemptively. So let's turn this over to Q&A at this point. And thank you, Kelly, for doing this. Appreciate it, because I know that everybody has lots of concerns, and we just want to leave everybody with as much information or, knowledge. And my friend Donna Miller, who was on the line before, right, said knowledge is power, but applied knowledge is really where. So I hope everybody's gathered a lot of knowledge from this conversation so far. What do we have, Kelly, as far as questions?
Thank you, Kim, and thank you, Kyle and Anu. This was really great. It's a meeting of the minds, and all the questions that are coming in are really reflecting that. So I'm hoping to get to as many as we can, but we might not get all of them. But first off, something, Kyle, you had mentioned earlier about New Jersey having the highest unemployment rate, and I've seen a number of questions that sort of fall under the umbrella of what I'm going to pose here. But how do you foresee the job market evolving in 2024? Like, are there specific industries or sectors expected to see substantial growth or decline?
So the first thing, I want to make sure that I'm clear, just so that I don't give out the wrong information. I don't believe we are the highest unemployment rate today, but we are in the top 5. I could pull that number up really quickly. I just want to make sure nobody leaves and says we are the highest. We are one of the highest.
Okay.
Excuse me. And then it's difficult from my standpoint to project individual industries. There's a lot at play in terms of who will benefit and who will suffer as we move forward. I mean, if we just look back at 2023, I don't know that we would have predicted some of the layoffs that we saw in the beginning of the year in the information sector. Now, do those start to come back in 2024? Do we see further declines there? But there are industries that, what I would say, there are industries where we are focused because of the need for them in New Jersey. So I can't predict that they will grow. I can tell you that I hope they grow because they are necessary to the functioning of our economy. And they are places where we're already seeing shortages reported. So just really quickly, they would be places like healthcare and health services, and we can talk about even at the individual occupational level where some of those shortages are, again, nursing being a prime example, manufacturing being another major one. We're constantly talking about combating the misperception that the manufacturing floor of 2023 or 2024 still looks like the manufacturing floor of 1950. It doesn't, and that perception leads to much lower rates of students who are interested in joining that industry because they think it is still, pulling levers and standing on the assembly line as opposed to the high-tech industry that it has become, and really where some of that groundbreaking technology, things like artificial intelligence, is implemented first, right? And so manufacturing, healthcare, I would also say infrastructure and construction, utilities, green energy in New Jersey. Obviously, we've had a step back in the wind sector. I still think green energy is going to be a major player in the state of New Jersey. So I can't predict that they will grow by any means. I would say their industries we're hoping will grow because there is a need for them to make sure that our economy is strong moving forward.
And if I can just chime in there, Kyle, we talked about previously as far as manufacturing, we have local County College of Morris that has a program where they are partnered with other manufacturing companies who are getting jobs for people. I know you've had some experience with that, correct?
Yeah, NJBIA has partnered with the community colleges in New Jersey on a program called the Pathways to Career Opportunities Program. If you're an employer who is interested in getting engaged with your community college, I'd really highly encourage you to. This program is focused on helping to ease the pathways for transition to different necessary occupations and also really for the most part, well-paying occupations. These are family-sustaining wages in a lot of these critical industries. And our community colleges are focused on making sure that if I am a lifelong learner, that I'm able to get in and out of the higher education system with ease so that I can continue to add credentials and add skills so that I can move from one occupation to the next or move up a career ladder in sectors like healthcare, information, manufacturing, and then getting those students connected with employers in their communities so they can either learn and earn while they're in their community college, or they can get placed once they finish that certification and actually start working day one.
Fantastic. I think that's a great resource, not only for those listening today, but maybe their kids and other grandkids and so forth, because in challenging times, what you can do is just elevate your education and put yourself above the rest so that when we have challenging hiring markets, you can shine differently. So thank you.
Excellent. So this, I think, will apply to a lot of people. We have a lot of business owners. We have people who have staff, even just self-employed. So if there were to be an economic downturn in the coming months, what would be maybe the 2 or 3 things you would recommend employers do to prepare for that? So this is open to whoever would like to go first. I'll pick. I do. How about you?
Sure. So I would say that the smaller businesses and small cap companies more broadly, that is an area that I'm watching very, very closely, because I think large cap companies are somewhat insulated because they've locked in those lower interest rates. So those higher rates are really not impacting them as much. The ones that are getting impacted are small cap companies, small businesses, individual business owners, etc. Now, between higher interest rates or higher debt servicing, higher payments for employees or higher wages, etc., and overall higher costs, those are the ones that are probably in the most challenging position. So now what do you do for 2024? Well, most certainly you want to probably use this time to actually build in efficiencies in the business. There's labor shortages, but are there things that can be automated? Right? So maybe invest in technology, invest in automation, robotics, etc. Are there other cost-cutting exercises that can happen? Take advantage of the TCJA or Tax Cut and Jobs Act till it lasts. So those are the things that you really want to invest in, and certainly also invest in just training of the employees that remain, that are that are important for the businesses.
Excellent. Kyle or Kim, would you like to add anything to that question or to that answer?
I would just add, and again, this is my area of expertise. It's not necessarily on the micro level. What I would just say is, again, you want to pay attention to your own business patterns, and certainly we cannot, as we've talked about, we've been predicting a recession for years now. The nice thing about predicting the same thing over and over again is eventually you'll be right? So will it be 24? Will it be 25? It's hard to say. I would pay attention to the trends that you're seeing locally and on the ground with your own business, and certainly at least recognize in preparing for an eventual downturn, whether it's 2024 or 2025, I would recommend being cognizant that the economic situation is changing, and at least take seriously, that word that I know Anu and I have used a couple of times, which is uncertainty. And the era of relatively free money in terms of borrowing is obviously over for a little while. We're watching a lot more, factors that are kind of on that edge. So I would certainly say, at least in terms of preparing, again, the financials are not my expertise, but I would say be aware that even though we've been predicting this for a number of years, there's a reason we still are, and there's a reason we're using that word uncertainty.
Yeah, and I would add that, we have clients that we're talking about, well, I say this all the time, planning for the unexpected as if it's expected. So if you're looking at all facets, whether it's, your protection elements, your liquidity, your income streams and so forth, and you're doing that inventory specific to you, then you're probably much better off than your neighbor, because a lot of people tend to procrastinate, right? If I talk about the roadblocks to financial independence, probably the number one is procrastination, because it's much easier not to open up the mail or, not to think about this or have those tough conversations. But once you do, you have peace of mind. You can put your head down the pillow and go, okay, all right, I got this. Well, I can't control everything, but I can control my behavior. So those are the type of conversations we're having.
Excellent. Now, with what you all sort of been saying, that they've been saying there might be, a recession, they've been predicting it. Now, are there any key risks or potential events that you believe could significantly impact the global economy in 2024? And if so, how, are there any additional advice to how businesses should prepare?
I'll just start by throwing out there, and unfortunately, this isn't a factor that you can prepare for. But your question was risks. I think we've talked a lot at this point about some of the embedded risks and the trends that we're seeing in the economy. The other big story here that has been a player in terms of inflation and the economic recovery has been everything that's happening outside of our borders. The situation in Ukraine and in Eastern Europe, the situation now developing in the Middle East. In Israel and Palestine. I mean, these international conflicts have significant consequences domestically as well. If we look at a policy level, it means, I was just reading this morning about the continuing fight. I think President Zelensky from Ukraine is in Washington right now, talking to Congress for more funding. There's only so much money to go around at a federal level. So if more funding is continuing to go to Ukraine, and I'm not taking a position on whether or not it should, but that may impact the amount of funding that can go to other programs. And we've talked about the cliffs on some of these pandemic era programs ending. When you have major conflict, it interrupts supply chains overseas, and it interrupts what's getting into the country and the price of what's getting in. It interrupts whether or not things can get in on time. And so we've seen shortages during the pandemic era and the consequences that can have economically. So I would just caution if we're talking about risks moving forward, and this isn't specific to 2024, but we have seen much more global uncertainty than we did, I think, in the decade prior. That will continue to have ramifications on our economy here domestically if these situations continue to play out the way that they have.
Excellent.
I will just add to that, the biggest risk is the unknown unknown. Now, obviously, that doesn't help too much because how do you prepare for the unknown unknown? Back in 2007, the fourth quarter of 2007, the economy grew at 2.5%. So no one expected the great financial crisis, and then it happened. I'm pretty sure in January of 2020, no one expected the great pandemic, and then it happened. So the point being that there's always uncertainty, there's always risks. Some are known, some are unknown, and the best way to prepare for that is to be prepared for the uncertainties, and the best way to do that is to be diversified.
Excellent.
Yeah, and I'm sorry, Kelly, I don't know if we have, it's like 2 minutes of, do we have any more time for questions, or shall I?
It's probably best to wrap it up because we've got, there's too many for us to get to. So
okay. Well, I would just, I want to end, on the idea that I believe, and I look at the world as the glass is half full. And if we walk around thinking it's half empty and we're pessimistic, then you will make it a self-fulfilling prophecy. And while we can't control everything, there are many things that are in our control. You need to get your news. You need to have a good understanding of what's going on in the world, but don't be overwhelmed by all of that. If you're doing what you need to be doing on a daily basis, right? If you have your someday goals, and those someday goals, you need to figure out what you need to do today, right now, next week, and so on and so forth. So here we are going into 2024. I'm a big advocate of visioning and vision boards. Create that vision for yourself, your family, right? Kyle has some great things coming up, expecting a child, right? So, you're in this for the long haul. You have to make sure that we're preparing for the future. So, I just want to say, understand, if we looked at Time Magazine for the last 15 years, the cover each month, our history does repeat itself. Oil crisis, wars, right? Financial crisis. Know that this too shall pass. Just being prepared will help you get to the other side much joyfully, healthy, and happy. And we wish you all a wonderful 2024. We hope that this update and economic analysis will give you some insight to where you should be thinking about, where it might be helpful for those you care about, because you want to be a blessing and not a burden. And so let's figure out how we can do that. And any questions that you have for Kyle, Anu, or myself, please feel free to reach out to Kelly and Donna and their team, or to Rachel and her team. Anything else. We loved having this conversation with you. Hopefully you found it valuable. Anything else, Kelly, you want to add before we say goodbye?
No, just thank you everyone for attending, and I'll drop the link again for next month. So join us, and I hope you all have a very happy new year and wonderful holiday season. Thank you, Kyle and Anu. This was really, really insightful, and it was I got a lot out of it. So thank you so much.
Fantastic. Take care, everyone. Thank you.
Thank you.